All right, good morning. Welcome to the webinar today. We will be talking a little long-term care, and so excited to have you on here. I know a number of people are still hopping on here, so we'll give them a few minute here to get everything set up on the Zoom tech here. So again, appreciate you hopping on. Today we're going to talk in long-term care. I know it's a set of a series of webinars we've had recently related to long-term care. And this one, we're going to get a little bit more deeper into setting the stage or the tone of a conversation, a little bit more different than tax deductions and some of the financial analysis that we've done on others. We'll touch base on that a little bit towards the end, just so those that haven't seen it, we'll give you the opportunity to get to the links and the blogs that are related to that on the financial side. But by quick introduction, my name is Dan Slater with Core Income Advisors. Started our firm here 13 years ago with my business partner, Tim Foley. And it's been a phenomenal ride. You know, we started much more down the annuity and lifetime income route. That's a little bit more my background. As an actuary, was designing and developing those products. But quickly within a couple of years, long-term care became a big component of our business in working with the financial advisors that we work with across the country, really as that financial protection, that risk management asset to protect a client's retirement and AUM, or the client's retirement and assets, but from an advisor standpoint, helping protect that client's retirement and the AUM that they're managing. And so we've really built a great team here to help support setting these policies in place, right? The conversation around risk management, as I'll open my screen here, the conversation as it relates to risk management, you know, we talk a lot about is identifying risks, and then based on the frequency and the severity of those risks, what are the different approaches that you can take to manage those risks? And so long-term care being one of those where there's a high likelihood of something occurring. You know, we'll go through some of those statistics in a little bit, but the severity of that can have a catastrophic impact from a financial standpoint. So that's going to be just a few of the things that we dive into here. So I appreciate as we get started. All right. So going to be a little different in some of the things we're talking about here, right? Because again, as an actuary, I usually dive very deep into the numbers. I want to identify the statistics and get people to try to understand the risks from a numeric standpoint. But this one's going to have a little bit more of a tone of the behavioral standpoint, right? And so what we want to do is really set the stage and the tone to be driven towards this idea of a commitment, right? There's certain stages in your life when you make decisions that aren't necessarily only financial driven, that aren't only instinctual driven, but based on the decisions you've made in your life, the commitments you've made, you may make a different decision for those around you, not just those for you. And so one of the quotes, I think this is a fabulous quote I've come across over the years related to long-term care, is that there are only four kinds of people related to caregiving in this world. Those who have already been a caregiver, those who are currently caregivers, those who will be a caregiver, and last is those who will need care given. And so we all fall into at least one of those four categories. Often, many of us will fall into multiple of those categories, being part of a sandwich generation where we're not only just taking care of our current retirement approaches, but maybe also those for our parents. And how do we manage the long-term care or extended care? You're going to hear me use those words quite a bit here today. I really like to think of it as extended care, not just long-term care. The general connotation around long-term care only is that idea of nursing home, but extended care is all forms of care. Both formal and informal caregiving. It's not just physical, it's also emotional and cognitive care. So a broadening the conversation to an extended care approach. So what is extended care, right? This is just the idea of needing assistance when someone has an impairment. When we talk about impairment, there's really two types of impairment. The first is physical. That's the one we're most often aware of, or clients are attuned to as it relates to thinking about long-term care. This is some type of chronic or debilitating illness. Really, you cannot perform 2 of your 6 activities of daily living, right? So you just need assistance to be able to physically function. On the right side, you'll see is cognitive impairment. And this is often missed by most people, but has become a large increasing trend of the type of care that needs to be given. So this is just your mind. So this is going to be Alzheimer's, dementia, things that physically you may have a strong body, but mentally you do need some type of level of supervision. And both of those take different forms of the type of care that's giving, but in essence, there's going to be someone who has to help take care of you in those scenarios. So when we talk about extended care, it not only affects you as the person that needs the care that's given, but most importantly, it also affects those directly around you. So often your spouse, your loved ones, your kids, and those who will be the caregivers in your situation, right? And so what we want to do is really think through a component of what gets people to make decisions, right? And so we're going to shift it a little bit from a risk-based conversation to a consequence-based conversation. I think you hear that a lot in the long-term care world, but really what gets someone to take action to the extent that they understand that there's consequences that surround them. And so we're going to separate a little bit of the behavioral component here between the way, maybe men think and the way that women think. And so it's a communication style. It's not exclusive to each, but I think it gives us a little bit of context to framing the type of conversations that you may come across as you're talking to different clients and prospects. And so we're going to kind of frame this in the idea of masculine and feminine, right? And so generally, just if you think back, innately over time, right? The male brain or the masculine brain, this is the hunting and the gathering and the protecting, right? There's an idea that there's an inherent risk of death or serious injury when you're doing some type of very risky behavior like hunting or protecting, right? And so mentally, there's been a need to almost separate the idea of the risk from the consequence. Because if you are likely to potentially die or have a serious injury, you probably wouldn't generally decide to take the risk that would lead to that. So there's been this idea of pulling those two things apart over many, many decades, centuries, so on and so on. So we've had to separate the idea of the risk from the consequence because we still had to make the action happen. On the feminine side, what you'll see is kind of the opposite of that, right? So you'll see traits favored toward nurturing and protecting. That could be family caregiving and so on. And so generally what you'll see is that the idea of a risk and a consequence are directly joined, almost so much that they're one and the same. That if you take the risk, it will be likely that the consequence will occur. And so really what we want to do is step into that idea of the way a client may be responding, either, defensively, they may be, putting the conversation to the side and understand, do they see the risk and the consequence together, or do they not see them related and they separate them from the beginning, right? And so what we really want to do is drive that conversation beyond the financial component, not just about the insurance, but more about the idea of the consequences of those around them, right? And so a consequence-based conversation is going to start with the idea of a commitment. And we really need to be strong in the idea of pivoting around the commitment that the decision maker has to those that are involved in their potential caregiving situation, right? There's other spots in people's lives where a commitment can drive direct behavior, right? One of them that we often come in contact with would be a new couple who just recently had a baby, right? The likelihood of someone maybe in their 20s or 30s, the likelihood of them passing away unexpectedly and dying is very, very, very low, right? Like 0.0001% likelihood of death in any particular year early in their lives. Yet the consequence of them dying has a significant impact on their spouse and their newborn baby. And when we think about that, right, people have a very strong sense of commitment at that time, right? You go from making stupid decisions and irrational decisions to the right decision. And when you generally instinctually know what that right decision is, but it's all this stuff around us and the world we're in and the time that goes by and the bills that come up and the things that are happening daily that distract us from that instinctual decision. And that instinctual decision is the commitment we made. We made a commitment to get married at a particular time. We made a commitment to our spouse. When you choose to have a child, you are making a commitment to your spouse and to your child. And along with that commitment are the decisions to protect those people that you have that commitment to. And long-term care is very much, or the extended care is very much in that same thing. It's not about the idea that this risk may or may not happen to you, but what are the consequences that are going to be affected to those that's happening to them? And so we really want to identify and not push the idea that you're going to need care, that you're going to go into a nursing home, that you're going to have physical or cognitive impairment. It's just that if you did, what effect would that have on those people around you, those people that you committed your life to the most? And how can we protect them? Okay. So we want to just step into this in three different ways. This allows us to help frame the conversations. Okay. So we're going to center the conversation around that commitment. We're going to discuss the potential consequences and we'll identify those three there. And then we really want to step into developing a plan. All right. So the idea of centering that conversation, again, I've already kind of touched base on this, but in a general sense, we want to steer this conversation to the idea of, are you going to create and leave a legacy, or are you going to create and leave a burden on those around you? And it really starts to shift a conversation when we ask questions like that, right? They're a little bit thought-provoking, but they're also a little bit of awakening, I would call it, right? Often you might see somebody shift back in their chair when you ask a question like that, because no one wants the question asked about the idea of creating a burden. No one has an intention of leaving a burden around those around them. But by often not making the decisions or not having the conversations, the burden is what is left over and is what developed. And so you're going to always get a few various responses from people, right? If you've had these conversations, here's a couple of them, but you know that there's a lot of aggressive responses that you often can get from people when you start talking about extended care and long-term care. The first one being something like, well, I took care of them. If we're talking, your kids, like, well, I took care of them for all those years, but they can take care of me when I need it. And the answer to that is yes, like they will take care of you. But then what, right? If we focus it just on the care versus the burden of the consequence, and we're going to touch base on the three consequences in the moment, it starts to think about that the care can be given, but what is that leftover burden or legacy potential that's there? Often, sometimes it's around the financial side, you'll get the response of, it's really none of their business, right? Like, this is me, this is my risk, I'll take care of it. But by not doing anything around it, or not having the conversations, or not having the plans, that inaction also does create and make it their business. Because when you have a cognitive or physical impairment, you can't do the things that you thought you wanted to do at that time, and that burden falls to your spouse and to your kids or whoever the caregiver would be. And generally, the best thing we could have would be almost an open-ended response back would be, well, what do you mean, right? If I'm talking about the idea of leaving that legacy or leaving a burden on those, if someone comes back and asks, well, what do you mean? That means that they are thinking through the commitment that they made to those and the impact that it's going to have on them, right? So all of those conversations, whatever the response is, that initial indicator is, we want it to lead to the idea of the impact that the event has to those that will end up being the caregiver or the coordinator of the caregiving, okay? Because it steps out of your own brain and puts you in the scenario of those around you. And these are the three consequences that I mentioned that we want to identify. When most people in our industry are talking about, and this is me, right? I'm an actuary. When most people are thinking about consequences or going to go into solutions, the first thing we generally identify and dive into is the financial consequence. So actually the one over to the far right, that you're going to have to pay for care. And we can create all the general arguments that when you have to pay for care, right, you're going to have to liquidate assets. Those might be assets that you had in various forms of different tax accounts. They may be different assets you may be selling during a market loss, right? Like, I can continue to create lots of scenarios where there's an advantage or disadvantage to the financial costs. We can identify that, the general cost of care is $10,000 a month for a nursing home and $5,000 a month for home health care, right? And so it's going to cost $200,000, $400,000, $600,000 in 20 years when you think about, 3% inflation over time. But really, the financial component is this, that we want to relieve the stress of that consequence. And you can do it in a very efficient manner, right? And so there are forms of insurance that we can talk about, and we'll get there. But if you don't have insurance, understand that when you start liquidating assets generates taxable consequences. Having more income and paying more taxes also then leads to potentially other tax issues on Social Security, and also leads to cost impacts to things like Medicare when you start liquidating assets. So there becomes this kind of vicious cycle of self-funding on the financial side that you may be able to do, but you also may be able to do it a lot smarter and easier for those that are around you, because they're the ones that are going to have to decide to liquidate the assets. You as the advisor are going to be talking to the spouse and to the kids about what assets are we going to liquidate, and deliver the bad news that you have higher taxes, deliver the bad news that your Medicare premiums are going to go up because you're recognizing more income to the client, right? It's the left too that we really want to continue to identify around that sense of commitment, is the impact both from a physical standpoint and an emotional standpoint. I mean, just physically, the conversation, right, you're having is usually with a 50-year-old to 60-year-old. They're both, in generally good physical condition, but we're talking about an event when you're in your 70s or your 80s or 90s, whatever that be. And so what is the potential or the capability of your caregiver at the time you'll need care? And what stress or impact does that put on them physically to have to take care of you as a physical being, right? To lift and carry you, to help you with those activities of daily living. For most people, that's not even possible, right? I mean, an 85-year-old spouse having to take care of another 85-year-old spouse is a huge physical stress on the caregiver, not on the caregiven. It's a huge physical stress on the caregiver. For those family members that end up taking care of you, right? They may have to physically change where they live. They may have to change their house. They may have to change their job, right? There's a lot of things that are involved there around the commitment you've made to them being able to live their best life as well. The middle one, I think, is very strong here, right? The idea of the emotional consequence. And, if we were in a room, I'd raise my hand and kind of see and ask, how many people have been involved as a caregiver, right? Maybe you've had a parent who's needed long-term care or has had an impairment, right? You may have had an aunt and uncle. You may have brothers and sisters. You may have kids that have needed some type of help, right? And care. And so the emotional burden that is passed at that time, the caregiver or the spouse and kids, their first instinct is to want to make sure that your emotional state is in a good spot, right? They're going through this event that is going to change the course of the rest of their lifetime as much as it's changing the course of the rest of your lifetime. And if they have to go into problem-solving mode of the physical care and the financial care, they're really being drained for their ability to be able to provide you and themselves the emotional care that you really probably want all of the focus of your caregiver to be, right? So we don't want to drain their energies from the physical care and that financial care so they can focus on that emotional connection to be able to help transition you and transition their families during that time of an event, especially right at the beginning of that event, right? The other thing is that everyone responds to those things differently. When we talk about that emotional care, the person who's getting the care, the primary caregiver, if you have kids, there may be 2 or 3 or 4 of the children that respond to it very differently and how they're involved in that. And you probably have stories from this, right? And so you can bring these up in client situations on the type of rifts that can be left for generations if that emotional care isn't handled delicately in advance. And so, again, leaving it to chance, meaning, well, they'll take care of me, is really only focusing over there on that physical side, right? I took care of them. They can take care of me financially. Like, sure, you have the money, but the real focus of everything here is that commitment to the emotional caregiving you want to give to your spouse and kids as the caregivers. And so, again, just identifying that's really where we want to have that commitment component really drive toward. And then you really, you want to move to action. You want to start to develop a plan. And then this isn't about like having every detail nailed down at the beginning, because I think this is a process. It's something over time, but you want to get it started, right? Like, this is definitely one of those things where one step is better than the whole is a great step versus having to think you have to have the whole thing done right away. And so we just want to start to identify in each of those 3 domains, emotionally, physically, financially, how can I help my commitment to those around me? Just general caregiver responsibilities, kind of who's the coordinator, who's the financial person, who's on the team, right? Where do you want to have care? Both geographically, right? People don't live in the same neighborhoods as the rest of their family anymore in the country, right? You may have different family members across the country. You may have a home, in Minnesota. Most people up here will have their home in the summer, and then they have their winter home, maybe down south in Arizona or Florida. Like, do you want it down there? Or do you want it up here, right? So geographically is a big deal, but also the idea of the type of facility. Most people want their care given in their home. But there are a lot of advantages to types of facilities, maybe assisted living facilities, based on the type of care you have or the type of care you need. And so what are those things that are most important, right? If a facility is right place for you, what does that mean to your spouse and the home that the spouse is living in? And then we're going to talk about that cost of care and the funding options, and just give an awareness to what it looks like and what it might mean from a financial standpoint, right? So really what we're trying to do by steering the conversation towards the commitment, it allows us to redirect a lot of the negative, the declination, the decline type of responses that we'll get, and lead it back to the consequences of those around you, right? So what if I don't live a long life, or what if I never need the care, right? These things matter in the type of approach or the response you're going to get. It doesn't mean that that's going to happen. I think we always want to affirmatively respond to their general response, but those responses are generally focused on themselves, not on those around them. So a positive response to them that's then redirected back to the consequences of those around them, and the commitment they made to them is really there. So I know initially from the email, these were a number of, we asked a question from the registration page of what are the things that often get in your way, that common objections, the things you're hearing as it relates to conversations and interactions around long-term care or extended care with your clients. Okay. I kind of categorize these. Our marketing team helped put these together, but there's probably 4 main categories as it related to the complexities of these conversations. The first being, it's expensive, or the cost, right? So there's a few things, and we'll dive a little bit more into this in a moment, but I do just want to highlight a couple thoughts initially, right? You don't always need maximum coverage, right? If you go to the cost of care on any website, or you go to a nursing home and it says $10,000 per month, the average stay is 3 to 4 years. So you need a policy that's that size, and it's going to cost you X dollars. That's a little bit of sticker shock. And just like anything we do when we think of offsetting the risk, it doesn't mean we have to offset the entirety of the risk. And so starting with the idea that any coverage is better than no coverage allows us to just enter the conversation from an adequacy standpoint. So often our focus is being able to cover the type of care that would be given in home first. So instead of $10,000 a month, something more in the range of $4,000 a month. The cost of care is transitioning significantly compared to just one generation ago. Because before, no one had any care given except informal spouse care given until the point they had to go into the nursing home, and then it was that 3 to 4 year stay at those very expensive costs. I think, and what we're starting to see, is most people's nursing home stays are actually getting shorter now. And that's because before the nursing home stay, there's better transitional care and formal or professional home health care that's given. So the care time is now a 5 to 8 year cycle, of which maybe only the last 2 years is in the nursing home. And so when we think about the cost of the care, we're actually shifting it forward, but at a significantly lower rate in the ability to give yourself care. Okay, so that's going to be a little bit in how we structure the policies, which will significantly bring down the cost of the premiums. Okay, and again, even if those policies are too expensive based on those premiums, and we got to cut that in half to $2,000 a month, it's always relative of the money you going in to the money going out. And so when we only look at cost, we're never really seeing what is the value or the benefits on the backside. Okay, kind of liken it to, we know that you can always get a good, I don't know what you need, like, some type of home good or groceries or whatever it be, is probably always cheaper at Walmart, right? Yet, do we go buy all of our clothes at Walmart? Do you buy your car at Walmart? Do you buy whatever it is at the cheapest place possible? And that answer is no. And the reason is because it's not because it's cheaper that you would just do it. It's because maybe the good isn't as good. It's not as quality. And so when we think about value, really, what am I getting from it? The idea of cost significantly changes. So one of the things we do a lot in that analysis is in our actuary lab. That allows you to show both the money in and the money out. When you think of IRR or net present value, I mean, it's going to significantly change if I can put in $4,000 a year and end up getting $500,000 of tax-free benefits out on the back end, which is 13-14% return on your money. Okay. So when we talk value and cost together, we can significantly shift the financial piece. Product knowledge, right? This is what our teams are fabulous at. Joe, Tyler, the rest of our life and linked benefit teams, long-term care, they know the products that are available. We have traditional LTC, albeit there's 1 to 2 carriers there, but the majority of everything is towards the linked benefit policies. So Securian, One America, Nationwide, you have Hancock going back into that market, right? These are policies that allow significantly better exit strategies, I guess you'd say, right? You can live with them, die with them, quit with them. They're not just long-term care only. So you're always going to get benefits out of that. But do you want indemnity? Do you want inflation on those policies? Those are a lot of the things that our team's going to be able to help navigate. What is the best or most efficient financial product that if they choose to buy the insurance, this is the direction we're going to want to go. Client resistance, right? We're going to touch base on this on the next slide, but we have a lot of materials available for you around presentations, common objections, the guidebooks, the things that you're going to be able to use for both clients and prospects to move them from interest to conversation to action, okay? So that's a process. Again, you want to introduce the conversation so at some point later you can move that towards action. So there's going to be a lot of materials for you there. And then around underwriting, right? This is very important in that you do have to qualify for coverage if you want to buy the insurance. And so understanding in advance, doing some pre-underwriting is definitely going to steer where do we go in terms of the product. Because if someone has some slight underwriting issues, we may be able to steer that towards a more simplified underwriting process. Now, you may not get as much leverage on your premium dollars, but any leverage is better than no leverage, and avoiding taxes is always better than paying taxes. So it may still drive to a particular insurance or solution, and that's where we'll help navigate there. So here's a spot where you can start to take and customize some of the materials that we've put together. A lot of these materials were developed with a number of the advisors that we work with. So we're not just creating this stuff in our own little ecosystem and box. We're working with advisors to white label or customize this client-facing collateral for your brand and your business. So I think our team is going to pop open a little poll here. You can click yes or no. Essentially, we'll be able to tag that to you. And we will reach out to you to help white label and customize these pieces directly for you. So if you have an interest in getting any of these materials, I think they're included maybe in the download section of the Zoom. But if you want them white labeled with your colors, your brand, your naming, just go ahead and click yes, and we'll be able to get those sent to you. We'll reach out to you. There's some things we got to gather as it relates to that. But the huge thing here is that idea of introducing the conversations from the prospecting side, but it's that workbook that's really, really critical in being able to begin to develop your plan and have that conversation of the things that are most important to develop this out. And then we also have a caregiver guidebook, right? So something you can use as a conversation piece. These are the things that as a caregiver, you're going to have to manage and work through at that time. So it's not just about in selling insurance. I mean, really none of this is very insurance or LTC policy directed. It's more about the conversation and the consequences and the answers you're going to have down the road. Okay. So what I want to do is just touch on the idea from a financial standpoint here. You may have seen this in some of my other presentations. You can link to our blogs as it relates to the financial side of this. But if insurance is the right direction for you to go, which, often we'll get the idea that, a person says that they want to self-fund. I actually love when someone says they want to self-fund, because if you want to self-fund, you definitely have enough assets to just buy the best policy possible and make an even smarter financial decision. Because insurance differentiates from every other asset class in two ways. The first is that it can provide leverage that other asset classes can't. Instantaneous leverage on your dollars. And the second is that it has taxable advantages in the fact that the IRS allows any benefits paid to you via long-term care, formal or informal, nursing home, home health care, it doesn't matter. All benefits are paid to you tax-free. And so when you combine leverage and tax-free, the self-funder should make the smartest decision and buy the policy and do it for pennies on the dollar as it relates to their own money. So when you buy one of these linked benefit policies, I always say you can live with your money, die with your, quit with your money, right? Those are the three ways you can get your money back. You can surrender the policy. If you die and never use it for long-term care, there's going to be a death benefit paid. And if you use it for long-term care, you're going to get significant leverage on your dollars, and that's all paid to you tax-free, okay? And really, every policy allows you to dial these up or dial these down. If you want more or less death benefit, you're going to get more or less long-term care. Same on the cash value side. So how much can we tilt these benefits to maximize the dollars in on the left side and the dollars out on the right side? That's just a general hypothetical example. I just want to give you an idea if you're new to this business, if you haven't seen these much before. But here's an example of a 65-year-old that, here, I want to pop open the pen. Sorry about that. So a 65-year-old female, and in this scenario, they're just buying a lump sum policy. So maybe she has $1.5 million. She's interested in protecting her spouse as the caregiver and the kids as the caregivers. This policy would instantaneously buy $360,000 of tax-free long-term care. But because we're including the inflation feature, at age 85, this pool for long-term care is now guaranteed to be $662,000 of long-term care benefits. If she never uses it for long-term care, we've kind of shrunk the DB down to provide more long-term care, but it eliminates the use it or lose it, because, if you never use it for long-term care, $113,000 is going to be paid to those potential caregivers. And then there's a return of premium option that if you do want to walk away with your money, at some point, it will allow you to have a cash value and get your money back, okay? So live with your money, die with your, quit with your money. Again, you see $100,000 going in, $660,000 coming back, but what is the time value of that money? What if you kept the $100,000 and just invested it and self-funded the idea of pulling the money out for long-term care? And so this is where a situation like our Actuary lab. So if you've been in Actuary lab, you would see this tool. If you've worked with our teams, they can produce these for you from our actuary lab. They're customized for you and that client. But this allows you to put the financial or time value of money component to the conversation. This is a 65-year-old who's putting in the $100,000 today. They're not receiving any money back because they're not triggering any claims. At age 80, they just start needing assistance, impairment at home. Securian allows you to be an indemnity-based policy. So this does not need to be a formal caregiver or a licensed caregiver. This can be your spouse, and you will automatically get the full monthly benefit paid to you tax-free. And so they start receiving $88,000, $90,000, $100,000, and they get paid that for over 6 years. And so the equivalent of this, for you to take $100,000 and generate this income stream in the future, it would require a return on investment of 10.6% per year. But not only would it take more than the 10.6, it would take more than that, because when you take a liquidation of this $88,000, you would also have to pay taxes on that. And so the taxes would leave you with $60,000 after tax dollars, whatever it be. So you would actually have to probably be generating a 13 to 14% return on your investments if you wanted to self-fund the ability to provide this type of money to your caregiver in your future, okay? And so you can see the amount of leverage you're getting and the ability to avoid all taxes for any type of formal or informal care at any type of facility, including your home, okay? Now, if you didn't want to buy the $100,000 policy, you could do a 10 pay, you could do a 15 pay. We could look at another carrier and you can do an annual pay. But for the same policy on the back end, right? So this is the same $662,000. You could do a 10 pay of $12,000 a year. So this 65-year-old could just start using other assets, right? You're the financial advisor. Just take an annual distribution of $12,000 and use that to fund the same exact policy. So from a financial standpoint, now you're not outlaying $100,000 today. You're going to outlay $12,000 a year for the next 10 years, and you're going to get that same long-term care benefit on the back end, the same leverage, and it all comes to you tax-free. Because you didn't pay all of your premiums up front, this actually increased the return on your investment for your premiums to the tune of 12.1% per year. Again, then dial that up because you'd have to be paying taxes on your distributions. The equivalent for the self-funder would now be 14 to 16% rate of return on your investments. And so you can kind of see why when we talked about the idea of the person that just wants to self-fund, they're the exact person that if they have $5 million and they're going to spend $600,000 for long-term care, why not use $12,000 a year out of their $5 million to buy a significantly beneficial policy, and they're getting a huge return on investment with that money, okay? Here's another example for a 40-year-old couple, right? So in this scenario, the earlier you buy these things, significantly cheaper premiums. So a 40-year-old couple with One America on the asset care policy, this is going to be $4,000 a month benefits with 3% inflation, and you're going to see an unlimited lifetime benefit period. So for as long as either or both of them will ever need care, this policy will be kicking out unlimited lifetime benefits for them. Now the premium, because they're so much younger, is significantly cheaper at $5,700 a year. So they can pay that premium out of pocket, right? It breaks it down. How much of that is going to life insurance? How much of that is going to long-term care? The important piece here is that when you look at this LTC premium, you may have the potential to take a tax deduction, or most importantly, you can use your HSA dollars to pay that portion of the premium up to their age-based max. So not only can we talk about tax-free leverage on the way out, you may be able to use pre-tax dollars on the way in. And I won't dive into this one because we have a whole different webinar on this, but this is also included in some of our pieces and stuff that we'll email out, or they're in the Zoom download section here today, is the tax deductions chart related to long-term care. So again, it matters if you're an individual or if you're a business. Here you'll see if you use your HSA dollars to buy a policy owned as an individual, you would be able to use that up to the age-based max. So that 40-year-old couple can each use $900 a year. So that's $2,000 of the $4,000 premium could be pulled from their HSA, and then they're just using their after-tax dollars for the remainder of that money. But as a business, understand you have the potential to fully deduct the premiums from the business and have it excluded as income to the employee. That is a huge, huge financial benefit that you can use for particular individuals within your company or your business. If you're looking to talk to more business owners, bring them the idea of a tax deduction, something like this. You can decide the pool or the group of individuals that would qualify, right? So this is not an ERISA benefit. So you can discriminate who gets the access to this benefit. But to get a deduction as a business and to not have it included as income to an employee could be a massive golden handcuff or executive benefit for you to bring to those business owners. Okay. And it matters if you're a C Corp or if it's an S Corp. If you're more than 2% owner of the S Corp, you can still do it, but you are limited up to the age-based max. So C Corps, often we may do the lump sum, full tax deduction, single policy. The S Corps, if you're the owner, we're probably doing more of the annual pay or the 10 pay, so we can maximize those tax deductions each year over time. Okay. And so those are going to be things we can go through with our sales team. If you want to hop on the prior recorded webinar that we have, or the blog goes very in detail, each of these situations for the tax deductions. This is also just a great chart to send to your CPA and your centers of influence, your estate planning attorneys, because they're always looking for opportunities, talking to their business owners to bring tax deductions and estate planning to them. And so if you're the one who's bringing them these ideas, obviously when they want to be able to take that tax deduction, they have to go through underwriting. They got to buy the policy. The policy's owned by the individuals. Like, everything from there works the exact same way as it would for one of your clients. So bring this as an idea in your group sharing events. Send it out as an email to your CPAs and your estate planning attorneys. Okay. So again, a lot of materials that we've kind of went through there today. Again, in the links, you'd be able to download them. If you want them customized, we do have your responses there, or just email us and talk through it. If you have particular clients that you want to see an example of as it relates to the insurance, like, let us go and put those analysis together. We can look at the ability to contrast and compare the different policies that would be available. But kind of just reiterating a lot of what we went through today, if somebody wants to buy insurance, it isn't as price competitive as a sale as maybe other forms of insurance is, like a term policy or an annuity from an income standpoint. If you want to buy the policy, you'll find the assets to be able to pay for the value of a policy that you can buy. But if we can navigate the conversation from a prospecting standpoint to generate the conversation related to the commitments that they've made to the spouse, the commitments they've made to their kids, or the commitments they've made to the caregivers that are going to be involved to provide them the care if that event ever happens. That's going to be a lot of those other materials that would be able to help navigate those conversations through. So again, give us a call, walk through those. We can get them to you. Also, just want to highlight here, if you go to our website, I mentioned the blog there. You can click on the blog and you'll see the tax deductions event there. But I do also want to highlight under the events and webinars page, we do have our insurance intel. We're hosting our next one here in July, and that one's booked. But we'll have 40 to 50 financial advisors going through that event. It's a no cost to you event. It's a day and a half. We get you here. We go through a lot of details. We get you out. And hopefully you take something with that. We still have 2 of them set here in 2025, September and November. We can send you the link, or you can go directly out to the web page and click sign up. We just need your basic info, and we get you the flights, we get you the hotel, we get you food, we have fun, we learn something, get you back on your way. It's been a very strong event for us. We've hosted 24 of those insurance intels over the last 5 years. If you've been to one, I'm sure you would hopefully say that it's fabulous. And if you haven't, you would have to experience it to be able to get that experience that you'd want to have and see. So with that, I think that's all we have for today. I don't know if there were specific questions or anything along the way. Maybe we can answer 1 or 2 of those if we do have any. Otherwise, we can definitely give us a call in here, and we can go through them one-on-one. So if you want to set up a one-on-one webinar with our team, give us a call. We can do that. Or if you want to talk to myself, we can do that as well. So, well, I guess appreciate everyone's hopping on here today. We'll be reaching out and connecting. Hopefully a few things landed. You can take a few things away. We'll get you your customized white labeled materials. Otherwise, hope to talk soon. See you around, and hopefully come out to our intel. Thank you.